How's it going, YouTube? My name is Christian with Plan Your Federal Retirement, back with another video with all about FERS. If you've ever been interested to lower your taxes and your tax liability in the future, this might be the video for you. So one of the things that we get asked about often and things that we talk about often have to do with Roth conversions. And what I wanted to talk through today is how doing a Roth conversion can lower your adjusted gross income, your AGI. It might seem counterintuitive, right? If we do a Roth conversion where we're taking our pre-tax IRA dollars, paying the taxes on them, moving them to a Roth IRA, that we would be increasing our tax liability by doing so. And this is absolutely correct. The year or years that we do Roth conversions, we will be increasing our adjusted gross income the years that we do them. But it's a little bit of a delayed gratification for why we do those Roth conversions. And so bear with me as I explain this. So think about a scenario where either it's you or somebody that you know is maybe not collecting their pension, or maybe they haven't started their Social Security, or their spouse hasn't started their Social Security. And we can envision a scenario where in the future, their taxes will be going up because of that fixed income that will be coming in. Additionally, you can also think about required minimum distributions, whether that's from the TSP that you have or other, 401ks or IRAs that you have, that once you are 73 years young or between 73 and 75, when those required minimum distributions will start, you will have to take money out of that pre-tax retirement account, even though you might not need that money to spend or to live on. So because of that, if we think about taxes, not just in this year or the next year, but we think about what our tax situation will be in the next 10 years or 10 plus years, now we can envision what our tax liability will be in the future. And that's why Roth conversions in particular can make a lot of sense, where we're intentionally paying the taxes and converting those dollars from pre-tax to Roth today, so that in the future, our future tax liability could either remain the same or be less than what we're thinking it would be if we did nothing. So again, thinking about the future sources of income that you have, whether that's pensions or Social Security. Maybe you have a rental property and you've got renters and you're planning to sell that rental property, and there might be some capital gains. So many other scenarios that we can be thinking of, like I mentioned, with the required minimum distributions, where each specific case is very unique. And so we have to think about, again, what is that future tax liability, with the default being if we did nothing. And the Roth conversions give us an opportunity to do something about that and to effectively take those dollars, instead of them compounding pre-tax to where whatever the value is today, and then it eventually grows to a higher value in the future, your required distribution is going to be based on that higher value in the future. So if we did that Roth conversion, either it be all at once, but probably more likely that we would do them systematically over a certain period of time, we would effectively be reducing that pre-tax account, increasing what we have in Roth, therefore reducing what those required distributions would be in the future. I've got lots of clients that maybe fit the scenario where their pension is starting, they're retiring, and we're choosing to delay that Social Security and when that would start. This is a perfect time to just be living on that pension income, and maybe we live on an outside account, such as a bank account or a non-retirement account, and keeping their tax bracket quite low. In that time period, we could do those Roth conversions, increasing temporarily what their adjusted gross income is for the year that we would be doing that conversion. And then in the future, that value of that retirement account, the pre-tax retirement account, would be less because we converted some of those dollars today, and now it's compounding inside of the Roth account. So really just food for thought. There's so many little details with the tax law. There's so many little details that you're going to want to involve a financial advisor, a tax professional who really understands this, to see how much, if any, would make sense for doing a Roth conversion. But there's lots of scenarios where if we do these Roth conversions right, we could really be lowering our adjusted gross income in the future years. So just, again, some things to be thinking about. If you have questions related to this, feel free to leave that question below in the comment section. Make sure you're subscribed to our YouTube channel so you get our latest videos that we're putting out. Leaving a like on the video always helps as well. And until next time, happy planning.